Hello everyone and welcome to week 5. This week we're covering chapter 19 and talking about not-for-profit entities. So the first learning objective is to understand financial reporting rules and to make basic journal entries for private, not-for-profit entities. So the types of not-for-profit organizations include colleges and universities, healthcare providers, voluntary health and welfare organizations, and other not-for-profit entities. Excluded entities these entities are not NPOs because they solely serve the economic interest of their owners, the members, participants, or trust beneficiaries. So this would include credit unions and mutual banks, employee benefit and pension plans, mutual insurance companies, farms and rural cooperatives, and trusts. Some characteristics of NPOs: they have no outside ownership interest. Their mission is to provide services to their users, patients, society as a whole, and other members, but not to make a profit. So their mission is not to make a profit, but to provide services. They have a dependence on significant levels of contributions, a significant level of assets that are restricted as to use because of donor stipulations, and they enjoy the tax-exempt status. Some differences between NPOs and businesses. Revenues and support are often compared to expenses. However, remember that expenses are incurred to provide services rather than to generate revenue, as in commercial accounting, and the purpose of NPOs is not to maximize the return on an ownership interest. So return on equity would not be applicable to NPOs. Some financial reporting differences for not-for-profit entities. The FASB is the entity that creates the accounting and financial reporting for non-governmental nonprofit entities. And then the GASB, the Government Accounting Standards Board, they create the rules for the accounting and financial reporting for governmental nonprofit entities. Private not-for-profit entities have to report their net assets in according to ASC 958-205, and they have 3 major financial statements. This includes the statement of financial position, the statement of activities, and the statement of cash flows. ASC 958-210 separates net assets into unrestricted net assets, those that are not restricted by the donor, and they can be used for general operations. And then there are temporary restricted net assets. These have donor-imposed time or purpose restrictions. If there are time restrictions, then the assets will not be available until after a certain time has passed. And if there is a term restriction, assets may be used only for a specific purpose. Permanently restricted net assets, such as regular endowments for which the principal must be preserved into perpetuity. Some not-for-profit entities use a fund structure to account for each type of net asset class. Other not-for-profit entities maintain only an accounting record to show the amounts in each net asset class. The specific identification of any restricted asset must be made when the asset comes into the entity, generally by donation or bequest. As restrictions are eliminated or met, resources are released and transferred from the restricted net asset class to the unrestricted net asset class. Accounting for contributions. Contributions can be either cash, other assets, or even the promise to give, which we call a pledge. Contributions of services are recognized as revenue, with an equivalent amount recorded as an expenditure if the services received create or enhance non-financial assets, or if they require specialized skills, are provided by individuals possessing these skills, and typically need to be purchased if they're not donated. So, for example, if someone donates accounting work, that would be recognized as revenue and an expenditure as well. Because if somebody didn't donate it, they would have to purchase and pay for an accountant. ASC 958 provides guidance specific to not-for-profit entities on things like accounting for depreciation, investments for general contributions, accounting for asset transfers to a not-for-profit organization that raises or holds contributions for others, and mergers and acquisitions of not-for-profit organizations. Depreciation has to be shown for long-lived tangible assets other than works of art or historical treasures, but long-lived tangible assets that have value worth preserving perpetually and whose holders have an ability to perverse that value and are doing so. It is reported as an expense for the period, just as it would be in normal accounting. And it requires disclosures of depreciation for the period, the total amount of the major classes of depreciable assets, the accumulated depreciation at the balance sheet date, and the method used to compute depreciation. Fair value should be the measurement basis for investments in all debt securities and in equity securities that have a determinable fair value other than those accounted for under the equity method. ASC 958 requires that debt securities be valued at fair value. Investments income includes interest or dividends and the changes in fair value. Investment income is reported as a change in unrestricted net assets. Contributions are measured at their fair value. Contributions are recognized as revenues or gains in the period that they're pledged. They're reported as either unrestricted or restricted support, depending on any donor-imposed restrictions. Contributions of service are recognized as revenue with an equivalent amount recorded as an expenditure if the reserves received create or enhance non-financial assets or require specialized skills that are provided by individuals possessing those skills and typically need to be purchased if they're not donated. ASC 958-605 defines three parties to the typical contribution process. You have the donor, who initially provides the resources, the recipient organization, who receives the assets from the donor. The beneficiary eventually receives these assets through the recipient organization as specified by the donor. Many not-for-profit private colleges and universities have a foundation that's responsible for raising financial support from alumni and other donors. When two not-for-profit entities merge, the newly formed entity should account for the merger using the carryover method. If the two entities previously used different standards, they may adjust the amounts of those assets and liabilities as necessary to reflect a consistent method of accounting. ASC 958-805-20 provides guidance for the NFP's acquisition of another, and ASC 958-805-35 requires that goodwill and other intangible assets be assigned to the reporting units that are acquired. So let's take a little quiz now that we've come to the end of the first learning objective. How do not-for-profit entities differ from for-profit businesses? Not-for-profit entities are prohibited from charging more than cost of goods or services provided, while for-profit businesses may include a markup. B, both for-profit businesses and not-for-profit organizations are tax exempt. C, Not-for-profit entities rely heavily on contributions and grants, while for-profit businesses rely on profitable operations for survival. Okay, so I don't really recall that they can't have a markup. It's not that they can't mark something up. It's just that whatever money they do make or receive has to go to provide the service that they're in the business of providing. So I don't think it's A. Both for-profit businesses and not-for-profit organizations are tax exempt. Only not-for-profit organizations are tax exempt. And so C, not-for-profit entities rely heavily on contributions and grants, while for-profit businesses rely on profitable operations for survival. I'm going to go with C. I think it's C. And yes, it is C. Not-for-profit entities rely heavily on contributions and grants, while for-profit businesses rely on profitable operations for survival. Okay, so that's the first learning objective for this week. I'm going to post this in the discussion, and I'll include a question for everyone to answer. I hope you all have a great week, and we're almost to the end, and I will see you in the discussion.